This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Investor Connect is a 501c3 nonprofit dedicated to the education of investors and startups for fundraising. Please consider donating $100 to the program to help others in their investor and entrepreneur journey. You can find the donate button on the investorconnect.org website. Well, hello, this is Hall Martin with Investor Connect. Today we're here with David Rosen, President and CEO at Acrelic Group. Acrelic Group is a strategic advisory firm headquartered in Boston, Massachusetts, with additional locations in Philly, Chicago, Cleveland, and Tel Aviv. Their principals are experienced business owners, operators, executives, and board directors who are focused on helping people and business achieve remarkable results. David, thank you for joining us.
Thank you for having me, Hall. I really appreciate your podcasts and the topics you're covering here. So glad to be here.
Great. So tell us more about your background.
I've been very lucky in my life, coming from nothing to being a tech advisor for half of my career to the Tech 250 500 and the Defense 10 companies where I work on tech commercialization. And my facilitation with these large tech companies has led me to over 40 M&A transactions in software, hardware, electronics, storage systems, and telecom. And it's also led me into helping them create many joint ventures, partnerships where they can fill in their gaps and leverage their strengths as they're looking to enter into new markets. And also even the options of greenfielding a new business to get into a new market as a way to achieve their longer term growth goals. So I've also been involved in just advising on what to do with intellectual property they own, and sometimes just licensing it to the industry so that they may not participate in the industry other than royalties coming out of other people using it because they may not have strengths there, or it may not be a strategic value to them to be in that business per se. And that intellectual property revenue is something that can generate significant revenue in many cases. The other half of my career has been spent in leading businesses. I've spent time doing a couple of turnarounds. I took one business from $15 million in revenue, and it was heading south from 22. And I turned that into a $150 million business in less than 5 years. I had hair when I started that job. And if you're not viewing this, just know that I don't have much hair left. And I've also started 7 companies. And so far, I've had 2.5 successful exits from them. And 2 of the companies are still in operation. And I still look forward to potential exits or potential growth for both of those. I've also been a board member on 9 companies and on 2 continents. And I'm also a strong believer in karma, where I believe that even when I'm deep down into a new startup or a new business or a turnaround, I still try and balance my time by being a mentor or a judge or a guest lecturer at universities and accelerators. So I've been involved at Rutgers, Northwestern, Boston University, and others to help be an advisor in startup accelerators. And then finally, when on my free time, I'm an angel investor. And I've invested in 2 accelerator programs that has given me a decent number of investments to follow, as well as 7 separate investments I made as an angel investor, not as a lead, but as a follow-on. And I try and stick to areas that I know well, where I can add some value to those startups. So sorry to make a short story long here.
So that's great. Well, tell us more about how do you help startup and growth companies?
Right now, our focus is on startups through middle market companies. And by middle market, I'm talking about the lower middle market, those companies that are between 10 and 250 million. And that's where our sweet spot is. Acrelic Group, as an advisory, is involved in accelerating the growth or helping the owners of those companies kind of navigate in and around inflection points or crises that they face in their businesses. Or we help them create significant change where they may not have the current understanding of what change options are available to them and then how to go pursue them. But our principals are all people like me, where we've come out of the C-suite. We've been owners and founders of companies, board members, looking at strategic issues down to, I'm a bootstrapper and how do I make payroll next month? And so we act as angel investors, as I mentioned before. We mentor startups in accelerators, and we are operating advisors to those growth companies, as I mentioned. And we can also, some of my team members act as fractional functional experts, where I've got CFOs of one of the venture capital groups that I worked for in my career. He's involved in working with growth stage through middle market companies as a CFO expert to kind of raise the maturity from typically a bookkeeping mentality to a CFO mentality, without a company having to pay for a full-time CFO, and help them transition and find the right people to manage and understand what decisions they could be making better from a financial viewpoint. And so I've been all around the startup ecosystem, from software to hardware, storage, telecom, semiconductors, and enterprise software. So we selectively take on startups, but we're very, very selective in startups. We're a little bit less selective in the middle market companies.
Great. And then what do you see as the challenge that startup and growth companies face in today's marketplace?
Yeah, it's a great question, Hall. I don't think any two startups have ever been alike, but they tend to have, what I think of as 6 common characteristics that you'll find in the startup founders. One of them is that many startups are founded by technical founders, and therefore they have a challenge in getting intimate with their customers and being clear about the goals, needs, and challenges of their customers and the ideal customer profiles that they're looking for, and that they have a fit between their product or service capabilities and the needs, goals, and challenges that a person has, which is normally termed as the value proposition. So if you don't define who your market is, it's not very easy to understand what your value proposition is going to be to that specific market, because it may vary from industry to industry or company size by company size. And so achieving customer intimacy and market intimacy is really critical. Again, probably the second issue is clarifying the value proposition. There's a lot of companies out there that are either trying to come to market as a platform, or they're coming to market as a product, but they tend to look at very broad-based value propositions. And their value propositions may be more of a vitamin as opposed to a pain reliever. And unless you have a really tight pain reliever when you're coming to market with something new and disruptive, it's not going to be easy to sell that pain reliever. And, I've started up companies and closed them down in the business plan stage because I couldn't find the pain relievers that were really necessary to create a value proposition that would be strong enough to compel the economics of the business. So I've reviewed probably 6 businesses I thought about starting and that I've shut down before even investing $1 in. But I put teams towards understanding the markets, understanding the technology, understanding the value proposition and the economics of the business, so we can plan before we fire. I think a third challenge for a startup company is recruiting great talent and understanding the division of labor and delegation of functional ownership to team members. Typically, I don't want to disparage startup founders, but sometimes startup founders, especially when they're still in college or in their 20s, have barely managed their own lunch money before they put themselves in a position of managing 3 founders and trying to figure out who's going to do what to whom and when as a startup. And so it's really important that these startups and the teams understand that they should divide and conquer wherever possible and understand each other's strengths and weaknesses so that you can be focused on the right things at the right time and the right role, as opposed to putting the wrong people in the wrong role at the other end of the spectrum. I also think, again, I tend to be very market or customer centric, but creating a North Star target is really important. And then understanding the path that gets you to that North Star, but also understanding the big challenge is being nimble on your way. It's always been my experience in looking at companies for acquisition or in my own companies that what I expected to be a year from now is completely different when I get there, right? I think a fifth issue is, I think I'm repeating myself, but it's also, are you really defining a pain reliever? And one of the venture capitalists that I worked for a long time ago has always gave me something that has sticks in my craw in my thinking every day. And that's the fact that platforms are earned, they're never born. And it's really up to the startup to stay focused very singularly on the features and benefits that will drive the greatest value to your ideal customer profile market segment and your target market segment so that you can get into the market. Because if you can't get into the market, you'll never sell a platform. You need to get into the market and get some successes by unhinging people, which is very difficult to do, or unhinging solutions that might currently be there or ways of doing business. And I think the last challenge that I think startups have is that if it's a startup with a very sexy value proposition and a very good story and people are very excited about it, one of the things that they're going to do is they're going to get a lot of advice from their friends, from potential investors, from colleagues, professors, everyone. And, you know, when you're early in your career and you're trying to please people, if somebody's giving you advice to go do something, you'll try and please them by going to do what they suggested you do. But the reality is you're going to get a lot of people giving you advice from their perspective that may not work for you. And therefore, you have to learn as a founder that your job is to filter out those things that are going to be most helpful and applicable to you, as opposed to something else that somebody suggested that sounds great, but it may not be doable by you or your team, or the approach that you're taking to business, or requires too much of a pivot from your current momentum. And you have to learn to be selective and learn, do I listen to 10% of this person or do I listen to 80%? So you've got to keep it in context to the capabilities that you're bringing together and the competencies that you have and your ability to execute on things, and not try and please everyone and do what they ask you to do. Does that make sense?
Yeah, no, that's absolutely true. Investors don't want people pleasers. They want someone that's, still running a good business. Investors do look for coachability, and so engaging with it at some level is pretty important. But I agree, you have to filter through because you'll get conflicting advice. What do you do with that?
Exactly. It's like putting 5 photographers into an all-white room and you never get 2 photos that look alike.
There you go. So how does a startup prepare for this challenge?
It's really the reverse of the challenges I mentioned, but spend time with buyers, decision makers, understand their risk profile, understand how they get compensated, understand what the profile of their organization is. You really need to understand everything you can about the buyer and what's going to create the opportunity for them to choose your solution over embedded solutions that might be there, or solutions that their own IT organization or their own manufacturing or operation says that they can take care of. But it's really the more time you spend being intimate with your customers and knowing where they come from, you will always survive. And as long as you're nimble and follow that. I think the second thing is therefore bounding it and bounding those markets by your target market, but understanding the subset of the serviceable and the universal market that you're participating in. You can't, and I coach a lot of college MBA programs for business plan competitions. And I always say the same thing. You can't just say, I'm going to get a certain minor mixture of the marketplace as my market share. And that's going to make me a big business. It's really understanding how you're going to unseat, what the alternatives are out there, and how you're going to create an economic value proposition that becomes a no-brainer so that the customer just imagines themselves sitting on a beach sipping mint juleps. I think another important thing is mapping the product features to and benefits to the persona, really understanding the intersection between the customer and your capabilities and what's in the middle that are those 3 or 4 things that become a no-brainer for them to think about and to articulate to their teams about why they want to spend the capital and change the way they go to business or go to market themselves because of your software or your solution or your service. The 4th thing is really understanding that when you're scaling a company and you're going to market, that the founding team of 1, 2, or 3 people can't have all their names in all the boxes. They need to understand what boxes they don't do well. And when it comes to scaling the business, where you need to have a commercial unit of a product versus a prototype versus an engineering sample, that they've got the right commercial unit that's been validated and tested, and that they have people who have worked in production who can help them understand how to deal with supply chain problems like we have today, and why a lot of companies' products are sitting off the shore of Los Angeles today and not getting to market. And so it's really knowing what boxes are critical for success and filling them in with people who can be dedicated to that and do a great job instead of doing a good job. And that's when coachable teams are really known to succeed. The other issue is that there are 4 things I look at in investments for myself or for others. One is the people. The second is how intimate and understanding of the markets are you? The third thing is how well do you understand the technology and product and service that you're bringing together in terms of its viability and doability? And then the thing between the most important item between the product or the market and the product are the business economics. Because if you can't produce a product with, let's say, 25% or 20% cost of goods sold to a market, then how are you going to compete in that market? When you look at a lot of these Kickstarter projects, you end up having, you raise $1 million for some number of customers, let's call it 1,000 customers. And then you spend $1,010,000 to create the first products and get them to market. That's if you get them to market, because a lot of startups haven't gotten their Kickstarted products to market. So if you're spending more than the revenue you're taking in, the rule of thumb is that if you've got a manufactured product, you should be at 25% or 20% cost of goods sold so that you can have other things like sales and marketing added on to your expenses in the business. So understanding that holistic view of the business, having an economic view of the business is really critical to know, especially when you go from 1 customer to 5 customers to 20 customers to 100 customers or 1,000 customers. There's different economics required to get you there. And if you don't know your business economics, you're going to get yourself in trouble. The last one is just very simple. It's when I've done due diligence on companies for myself again or others, I always look for the clarity of strategy and an understanding of how the business makes money. And what I find alarming is when you talk to the top 3 or 4 people of a business and you ask them what business they're in, and they give you, those 4 or 5 people will give you 10 to 12 answers, you've got a problem. Whereas the ones that are ask these 4 or 5 people and you get 2 or 3 answers, that's when you know that they're communicating effectively, that they're pivoting effectively, and they know what business they're in and how they're making money, and that they're consistent, and that they're acting like a group that has greater value than the sum of the individuals. And that's where communications comes in, and being really clear about, hey, our North Star target moved 5 degrees, so we have to be nimble and pivot 3 degrees now and then 2 degrees later.
Great. So who should the startup recruit to help with these challenges?
I would say there are so many different accelerator options out there that are very, very valuable to startups in terms of helping them understand those four pillars I talked about: people, the markets, the business economics, and the product technology viability, and all the things around it, whether it's managing the cap table and understanding what happens when you take in investors, or how do you find your product market fit. All these accelerator programs are geared towards helping. Some of them you pay them for the privilege of being in their program. Others will fund you with money to be in the program and take a portion of your equity as a part of doing that. But either way, I would seek those accelerators out because they also keep an ecosystem of very smart people around them who have typically been there and done that. I would also look to bring on advisors that can help you in some of the gaps you have that you may need to fulfill, whether it's how to do business with large companies when you're such a small company. A lot of people have that fear. I've never had that fear. I started my first consulting business, management consulting business, when I was 22 years old. But I did it because I brought very experienced gray-haired people into the situation to validate the industry understanding. And I was very good at process. So the combination of the industry expertise and the process could make the president of an IBM business unit feel comfortable that we understood what it was going to take to have him or her present to their board and get X amount of capital to go do an acquisition or to go do a joint venture. So I would look to fill in gaps with smart people around. In almost every city today, in the top 200 cities in the country, you can find startup accelerators. And so wherever you are, there's typically some sort of entrepreneurial groups that you can reach out to and find. And I think there's other firms that are out there that will help you for a fee to get to market and help you understand where your gaps are and help you understand how to organize effectively and how to be more customer centric. But you have to be careful because it's hard to afford that when you're bootstrapping or when you have limited capital for your business.
Great. And so what are the must-dos for the growth company out there? What should they be doing different from a startup?
Good question. I don't think there's any better way to succeed in a business without getting more intimate with your customers and understanding who they are and how to reach them expeditiously. It's about time to market. And I think growth scaling companies need to understand that in some cases, they may be thinking locally instead of thinking bigger and thinking nationally. And so is their objective to create a pizza restaurant in their town, or maybe a couple of pizza restaurants in their town? Or do they want to create the next national chain of pizza parlors around the country? And so you really have to grow your magnitude and understand what you're trying to target and how do you get there? Because there's many different ways to get there. In the restaurant example today, you've got all these shadow kitchens that you can hire to create a virtual presence in every city and have those kitchens, deliver your food or product to the local market without having to have a single retail store. So think about that. You've got these shadow environments that can give you a complete operational capability just by creating some relationships, and you can have a nationwide presence. Same thing with cold packers that are doing food delivery. There's cold packers in almost every town now. And so some of these companies have realized that they can rely on those cold packers to do their lettuce shredding and other things like that. So there's different ways to get there, and it doesn't always have to be that local approach. For growth stage company, again, it's about bringing in the right people for the right role. So if you need to cookie cutter your approach and then you need to train, what kind of training people do you have? Do you have train the trainers that are coming in so that you can replicate what you're doing in one place and replicate it in 100 places at a time by having a good process that's easy to follow? Or are you going to just, bring everybody back to your central location, train them at a very high cost, and then send them back out in the world and have no customer service or support for them. So again, it's about understanding the roles that are required to achieve that North Star and how you get there. That's really critical, where a lot of people underinvest. In many companies that I work with that are physical product based, there's a tendency to forget about customer support and service. So all of a sudden you're halfway into the build of a company, and I would ask the question like, so how are you going to handle warranties? Are you going to put a reserve aside to be able to have spare parts that go out to the product? How are you going to get those spare parts out there? Who's going to answer the phone to then create a trouble ticket? And then that trouble ticket goes to some unknown service provider that's going to go out and install that new product or part on that system. And you would be surprised, Hall, how many people I've seen that are just sitting there looking at me bug-eyed, like they had no idea that they had to do that.
It's amazing what they learn as they go. So where do you see companies underinvest?
That's a good question. I don't think they spend enough time on market validation. And I keep repeating that because I do see a lot more companies that are technology-led or expertise-led, and they think that somebody wants something that's going to do 3 times the amount of capacity that something's doing today. Well, that's great. But when you start looking at the thing that is doing 3 times less, there doesn't seem to be a market for those things. So why would there be something for something that can do three times more when you haven't validated the market? So I think it's really important, because a lot of startup founders will put themselves in as a proxy for their customer base. And they'll say, well, I know this customer base really well. I know what they want, and therefore I'll make the final decisions. And I really start wondering if I should continue to work for people like that, because they don't listen to the market. The market should be giving the feedback, and that's where you learn the most going forward, not from guesstimating what the market wants from your own perspective. So that's an underinvestment. And I think sometimes they underinvest in people, and we've talked about that a lot, Hall.
Okay. And where do you see companies overinvest?
Because you see a lot of companies that are technology-led, they tend to overinvest in technology. And in the software industry, you have a different economic model than hardware. But in software, for example, at some point in time, you get the version 1.0 and your product is done. It just needs to be maintained. It needs to be grown as you get more users. But you never see development teams or design teams slowing down. And so they're working on new features and new functions without getting customer feedback. And so that's where they're over-investing, because they're investing in things that aren't tied back to one of 2 transactions. 1, retaining customers and getting them to love your product more, or 2, helping you to acquire new customers in the capabilities that you should have, as opposed to those capabilities that you think people want, but aren't really demonstrating that they're helping you get lift. I think a lot of startup companies overinvest in customer acquisition costs. They hire salespeople 6 months before their product is ready, or they spend significant amounts of branding and advertising on their brand without having a product available, or they believe that the brand is going to drive their sales, not salespeople driving their sales. And so they tend to overinvest in branding and marketing, because in some cases, they're either in an industry that they're just a small part of a multi-trillion-dollar industry like fashion, where you almost need to spend $100 million to get your brand out there. And maybe that's not the right choice to build a brand. Maybe you should be choosing to be really clear about your value proposition of your one thing before you create a brand. And so that, again, is an overinvestment. And then finally, again, I hope I'm not sounding like a broken record, Hall, but platforms are earned, they're never born. And so starting off with a broad product line with 10 features or benefits without being clear about the economic value proposition to a customer is overinvesting in that platform. Because if you don't penetrate new accounts and get in at a very focused level where you know you can unearth somebody else, then you won't get in. So the platform won't do you any good.
Great. So What do you do when you're short on the fundraise? Who takes the haircut and by how much?
I'm a bootstrapper by nature, Hall, and I'm probably more proud of the customer revenue I've raised than the equity revenue or equity capital that I've raised. So for me, this is just a part of life. When you have no money, you have to figure out how to do the most with no money. And so it's really important that you improvise and you be nimble. And same thing with corporate budgets. If you're running a business unit and you say you need $20 million, you're only going to get 15 and you still have to figure out how to spend the 15. But you also know that they're going to ask for another million back before the end of the year because of some other business that's not doing well. And so you really can't even spend the 15 that you expect to spend. So same thing, you have to have that same mindset with your startup that whatever you can do, you can do. If you get $1 million and you thought you needed $1.5 million, what things are you working on that's going to give you the greatest return to get the traction you need to get into that new market? And so it's all about prioritizing, and it's all about clarifying for everyone that, hey, we're not doing items number 4 and 5. We only have enough money to focus on 1, 2, and 3. So we're going to be the best 1, 2, and 3 that we ever can. And we're going to make that work, and we're going to make up for it in the long run. Because the backstory, Hall, to a startup is very much that every day you're in business and you're making progress, your valuation increases. And so if you didn't make the money that you expected to raise, figure it out and see what's doable with the money that you did raise and see if it can get you there. If it doesn't, then you have some other questions to ask. Do you put in more money yourself? Do you take out credit card loans? Do you invest in it yourself and take more of a risk? But then you should get some sort of quid pro quo for taking that additional risk, and it should show up on your cap table somewhere. So that's kind of my perspective on fundraising, if that's helpful.
Well, that's a good point. In the last few minutes that we have here, what else should we cover that we haven't?
What I see the most is really about what I've been focused on is where software connects with physical products. And as we all know, China is really a place that has set up their 2025 policy where 70% of their consumed goods will have to come out of China. And so we have to start expecting that more manufacturing will be coming out of the US. And I think it's really important for people to understand that we can be competitive in manufacturing our own products and services, especially in the environment we're in, where it's all about mass customization and mass personalization. And that's going to require a variety of new manufacturing technologies, new supply chain thinking. And so there's a lot going on where we are still the largest consuming country in the world, and manufacturing is moving back closer to demand. And so if those things are true, which they have been true, that more manufacturing is coming back to the US. And so that's one of the areas where we spend some time around manufacturing in the middle market, because we believe that the opportunities there are just tremendous, even in traditional, more legacy businesses. So that's the only add I would add to this.
That's a good point too. So how best for listeners to get back in touch with you?
Well, they can always reach me on Acrelicgroup.com's website, and we have contact us forms there. It also has our phone number, and I'm pretty old fashioned. I still use the phone. I was joking about this with one of the top VCs here in Boston, that he really uses the phone and prefers to have people call him, and so do I. So you can reach Acrelic Group at 617-865-4770. And of course, we're on LinkedIn at Acrelic Group or David Rosen, LinkedIn. And that's the best way to reach us. Pick up the phone or schedule time with us, even from our website.
Great. We'll include those in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Thank you, Hall. I really appreciate your time, and I'm sorry if I talked a lot.
No, it's good stuff, and appreciate you sharing it.
Thank you, Hall. Be well and be safe and be healthy.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.